This is Matthew Cratter from Trader University, and today I want to answer the question, what exactly is modern monetary theory, or MMT? It's been in the news a lot. I do believe it's coming, so I wanted to make a video about this. If you're interested in learning about how the economy actually works, so will know how to make money in both bull and bear markets, be sure to hit that subscribe button. So a lot of people portray, especially a lot of our elites portray modern monetary theory as this utopian new economic theory that's going to bring prosperity to everyone. I want to teach you exactly what it is so you can make up your own mind about it. So to do that, we're going to have to build up to the stage of MMT and make sure that we're all on the same page. So the most basic system of government is where you have a government that taxes its citizens and then spends that money back into the economy. This is sort of the most basic form of government where a portion of the citizen's income is sent back to the government in the form of taxes, and then it is spent hopefully to benefit the people of the country. In actual practice, it's usually diverted to help out government buddies, etc. But in an ideal version of it, it's spent on roads, other infrastructure, sort of police, protecting the general population. Hopefully have good police who are doing their job well, defense spending, defending the country from outside enemies, and then helping those who cannot earn enough money on their own. So free food and housing for the very poor. So this would be the most basic version where just government taxes are spent into the economy. And taxes are basically what make up most of the government budget. Now, usually governments will spend more money than they raise in taxes. Certainly large sovereign governments today. And so the model for this is the government will borrow money from its citizens by issuing debt, by issuing government debt. And if any of you have ever owned U.S. Treasuries, that's what these are. Basically, the government says, you give me some money, we'll tie it up for 5 years, I'll pay you interest on it. In practice, you can actually trade out of it before 5 years. It's not like a CD, but basically 5-year Treasury, I'll pay you interest twice a year, and then at the end of 5 years, you'll get your original money back. Now, this can be good or bad depending on what the money is spent on. Obviously, if you spend it on infrastructure, if you spend it on sort of long-term investments, the famous Eisenhower interstate highway system, which was actually developed before him and is continued to be developed, this was a great investment in the infrastructure of the U.S. It made possible a lot more travel and trucking, etc. So this would be an example of where the government spent more money than it had. It issued debt to do it, but it basically reinvested that money into the country and created a good long-term asset, the interstate highway system. Now, borrowing money can also be useful if you need to fight a war. If there's no point being completely fiscally conservative if you're about to be invaded and you're all going to be occupied. World War II is a great example people give. Obviously, the U.S. was not completely in danger of being invaded. The Japanese might have been able to invade it. But classic example of wartime spending, where you just spend as much money as you need to defeat external enemies. And you can't really tax your citizens enough to pay for it, but it's probably good long-term investment. So you issue a lot of debt and you defend the country. So those would be two examples: spending on infrastructure, defending the country from invasions. You can argue that a lot of the more recent U.S. wars have been less about defending the country or defending our borders, but actually defending, going on these sort of foreign expeditions. So another use of when the government borrows money, maybe this money is just spent on very high government salaries. Maybe it's spent on building giant palaces for the ruling class. If so, this is not a good long-term investment. It creates a lot of resentment. There's no real ROI, a return on investment from, maybe there is hundreds of years later when people see these beautiful palaces and you can use them for tourism. But this is probably not as good of an investment as spending on infrastructure or something like that. Now, there can be a problem with government borrowing, and this is the phenomenon what economists call crowding out. So instead of lending my money to Uncle Sam in terms of buying treasuries, I actually could have used it perhaps to start a new business, or I could have put it in the bank where it would be fractionally reserved and lent out to other people starting new businesses. So if you have a government that is just borrowing domestically from its own citizens, and it's doing a lot of this can have an effect where it crowds out private investment. So this is something to keep in mind. So we have the first model where the government just taxes. The second model where the government continues to tax but also borrows money from its citizens. Now the next stage would be maybe the government wants to raise even more money, and so what it can do is it can then borrow money from people outside the country, from non-citizens, from foreigners, from international investors, whatever you want to call them. The great example here is the U.S. Selling our treasuries to mostly Chinese and Asian central banks, China and Japan, private citizens as well. And this has the advantage that obviously you can raise a lot more money. You can do this on a really large scale. And there was sort of this deal that we had with China since it entered the WTO. They would buy our treasuries. We would outsource all of our manufacturing to them. All the factories would be shipped over to China. All the jobs would be shipped over to China. And we would basically get to focus on sort of the higher end of the manufacturing process. Now, this was good in the sense that it led to lower prices. Obviously, Chinese labor, especially back in the early 2000s, which labor costs were much lower, wages were much lower in China than the U.S. So this was very good for corporations. It was good for people who own stock. It was not as good for the middle and working classes in the U.S. because so many of these manufacturing jobs were shipped overseas, whether to Mexico or to China or to the Philippines or Indonesia, wherever. And so this was sort of the trade-off. It was much better for the upper middle classes and the sort of the ruling class. And the U.S. U.S. workers at the high end of the pyramid, they got to do software and finance. If you buy an iPhone, you see on the box is something like designed in California. So they got to do the really fancy, cool stuff that didn't involve heavy metals and sort of dirty manufacturing in Silicon Valley, while the Chinese got to actually assemble these phones at Foxconn and work 18-hour days, and they had to put bars on the windows of the factories because they were having so many suicides. So there's always a dark side to this. But on the surface, it was fairly good for Americans, especially if you were upper middle class or above. It was devastating, really hollowed out the middle class and the working class as these manufacturing jobs were shipped overseas. The people who really benefited were the people who did finance, hedge fund guys, financial engineering, software, etc. Not good for people who actually made stuff. Now, hopefully after COVID, a lot of this will actually come back to the U.S. Now, the hollowing out of the middle class, basically, and again, we're talking about the U.S. government borrowing from mostly Asian countries. This led to the hollowing out of the middle class, led to class warfare, populism in politics, the rise of Trump, a lot of civil unrest, and a lot of very violent politics, both from the left and the right. It also meant that the U.S. had to run these very large current account deficits, which basically meant more money was flowing out of the country than was coming into the country. And what this also meant was that there was increasing foreign ownership of U.S. assets like stocks and real estate. And as a result, the U.S. for many years has had what's called a negative NIP, negative net international investment position, where foreigners own more U.S. assets than U.S. citizens own foreign assets. So you have this weird situation where it doesn't matter quite as much in a globalist situation, but you have a weird situation where outsiders, quote unquote outsiders, own more and more of your country. So this can be sort of the dark side of a government borrowing from outside and doing it on a very large scale, as the U.S. has done. So we have the three stages: government taxes to spend, government borrows from its own citizens to spend, then the government can borrow from foreign governments, from international investors. But what happens if the government, in this case, we're really talking about the U.S. government, what happens if it just starts issuing so much debt that there's no longer any foreign appetite for it? So this is what happened in 2014, really. International investors, especially China, they stopped increasing their holdings of U.S. Treasuries. They still hold U.S. Treasuries, but they haven't really been growing it since then. Now, we can't sell our government debt to people, to aliens or to UFOs or to people who live on Mars. And so what this meant as the U.S. government increasingly ran these larger and larger budget deficits and had to borrow more and more money, someone had to buy these U.S. Treasuries. And so from 2014 really to 2018, it was the big U.S. banks. They had balance sheet room for it. So your JP Morgans, your Bank of Americas, your Goldman Sachs, they bought it. Also hedge funds, a lot of institutional investors bought Treasuries for their various strategies. So basically had the U.S. government just spouting out all these Treasuries, and you had the big banks and hedge funds mopping up the supply. But the budget deficits got too high, even under Republican leadership, which always says it's going to be fiscally conservative, but never is. We had these $1 trillion budget deficits even before COVID. And what this meant was that there was too much government debt being issued. It was almost like a crowding out. There was no one left to buy all this government debt, all these U.S. Treasuries. China didn't want any more. Russia didn't want any more. The U.S. banks and hedge funds got stuffed so full that we had a repo crisis in late 2018. I've talked about that in other videos, but what it basically meant was we had to rely on the buyer of last resort, which was the U.S. Central Bank, also called the Federal Reserve. So in late 2018, they stopped shrinking their balance sheet. They actually started printing dollars and buying U.S. Treasuries. This is the central bank buying U.S. Treasuries from the federal government. Now, the way this works is the U.S. Treasury, which is part of the federal government, sells these government bonds to the Fed via primary dealer banks, which we'll talk about in a minute. This is Goldman Sachs, Cantor Fitzgerald, etc., and then gives that cash to Congress to spend. And as we said, the Fed buys this government debt with newly printed U.S. dollars. So the way this works, the central bank, in this case the Fed, this is called quantitative easing. You'll hear it referred to as QE, where the central bank makes up new dollars, prints them using the digital printing press. We're obviously not talking about paper. It prints new money and buys stuff with it. It mostly buys U.S. Treasuries, but lately in 2020, in the wake of the COVID crisis, the Fed has been buying municipal bonds. It's been buying corporate bonds, in other words, the bonds of corporations like Apple and Tesla. It's even been buying junk bonds. These are sort of zombie companies that would be out of business if they didn't have people to buy their high yield bonds. And so what does the Fed get in return? It gets a fancy piece of paper, a digital piece of paper, we should say, a digital certificate that says that it owns a U.S. Treasury or it owns a bond. This is, I always refer to this as the Fed's balance sheet. They've grown their assets since 2008, since really before the great financial crisis of 2008 to 2009. Their balance sheet stood at about, it was about 900 million, so under 1 trillion, and it has since grown to over 7 trillion in just 12 short years. You can see most of that spike has really happened in the last year, in the first quarter of 2020. This is because the Fed has become the buyer of last resort. We're running these huge budget deficits, which are increased by COVID, all the extra checks, all the money that has to be sent to people who have lost their jobs because of the pandemic. And as a result, the Fed has to mop up all of this government paper. Now, how exactly does this work? I alluded to it a minute ago. The U.S. Treasury borrows money by selling government bonds. It sells them at an auction. I believe these auctions are once a week. And it sells these bonds to big banks. There's a list of them. You can look it up. They're called the primary dealers. Famous names like Goldman Sachs, JP Morgan. There's basically a government auction, and the big banks buy this debt. And then the big banks, they can't hold all of it, or they don't want to hold it for a very long period of time. So then they sell it to the Federal Reserve. The Federal Reserve, our central bank, prints new money, gives it to the big bank. They get the government bond. The Federal Reserve gets the government bond. They get to put it on their balance sheet, which we saw right here. And the big banks are there sort of in the middle, simply because it's illegal for the U.S. Treasury to borrow money directly from the central bank. There's this sort of illusion that that we're not yet living in a clown world, that there's this sort of legal protection where the U.S. Treasury can't do it directly, so they do go through the big banks in order to do that. But I believe we are already in clown world. Modern monetary theory is a great sign of it. When I see the Federal Reserve here, when I see the FOMC, I see these faces. This is actually what I see. I think this is a much more accurate representation. It is incredibly bizarre where we have come. And so the next step really is MMT. We have quantitative easing where the Fed just buys stuff, puts it on their balance sheet. But this is already so fake, and we're doing so much of it. There was originally the thought, what the Fed promised everyone back in 2008, 2009, was that they would shrink their balance sheet, that they would stop doing QE. And instead, they did QE1, they did QE2, they did QE3. They tried to shrink their balance sheet in 2018. The whole world began to blow up. The stock market went down. And so there's no longer really the pretense that they will ever be able to shrink their balance sheet. This thing will grow forever and forever, and it'll be funded by newly printed dollars. Now, everyone knows there's never a free lunch in the world. But if you have people from Harvard, if you have people from Princeton saying these things are good, a lot of people believe them, especially if you use fancy terms like MMT or modern monetary theory. It gives the illusion that you're talking about something that's real, but it really is clown world in my opinion. So what MMT says is why go through this whole charade? In many ways, MMT is more honest than QE because they don't even pretend. They're extremely blatant. So why pretend that the Fed is loaning money to the U.S. government when we know that it's not really a loan because it's never going to be paid back? It's always going to be rolled into new debt. The U.S. Treasury will issue new debt to pay off old debt, and all of this new debt will also be financed by new dollars printed by the Federal Reserve. So in the current system, I should have said we have the U.S. Treasury, which is part of the federal government. They can tax. If you pay your taxes in the U.S., as you should, you'll see that you write your check to the U.S. Treasury. They can borrow by issuing government bonds, and they can also spend. They can send the money over to Congress to be spent. Now, the Federal Reserve, as we said, they can lend money, but they cannot spend. But when you get this coordination between the U.S. Treasury and the Federal Reserve, as we've been seeing over the last few years, working together, what they're doing, they're basically already doing MMT in if not concretely, they're essentially doing it. So the next step is just to say, we're in clown world, why even pretend? So this is what MMT is, and I think I'm going to have to make another video about this. So this will be part one, because it's taken us so long just to get here. But MMT, the government, instead of pretending, instead of going through the charade where the Federal Reserve prints money and gives it to the U.S. Treasury, and the U.S. Treasury gives them a piece of paper saying you own a U.S. Treasury, you own a government bond. Basically, you just have the federal government create as much money as it wants. So it's like, well, we need $4 trillion this year. We just press a button on our computer, and we have $4 trillion to spend. It's really easy. And so they don't even pretend. They don't pretend with the Federal Reserve or the U.S. Treasury or primary dealers or all of this elaborate infrastructure. Government just creates money as much as it needs to spend. You can already see the problem with this because politicians are not exactly the most disciplined people, and government has a tendency to always get bigger and bigger. It never gets smaller. It gets bigger and bigger like a balloon until it explodes. This is one problem with MMT that we'll talk about. But basically, the government just creates as much money as it wants. And then what they do is if they start to see inflation in the system, if they're growing the money supply faster than the real economy can withstand, basically they'll just raise taxes. And this, because you have to pay your taxes in US dollars if you live in the US, this will suck some of the money out of the system. And so you have two ways in MMT. You basically have two functions. You have spending, government spending, where the government just creates money out of nowhere and injects these dollars into the economy. It can spend it on whatever it wants. It can spend it on very good projects like highway infrastructure or maybe upgrading the internet or something like this, maybe a space program. So it can spend it on good things or it can spend it on bad things. It can spend it on corporate welfare, just giving free checks to very large business owners in the form of loans and then forgiving those loans. So it can be spent on productive things or unproductive things, and people will be able to argue about this and have their idea what is productive and what's not. That's the one side of MMT, spending money to inject dollars into the economy. The other side is taxing, sucking dollars back out of the economy if things get a little bit too overheated and inflationary. Now you can see the problem with this just on the surface of things. Governments love to spend. I mean, who wouldn't want to spend? If someone gave me unlimited spending power, I would probably spend quite a bit of it. And taxes are very unpopular politically. If you want to get elected, if you're on a 4-year cycle or a 6-year cycle or a 2-year cycle, you do not want to be raising taxes. Taxes are especially unpopular among the rich, who are funding the lobbyists, who help you, who sort of manipulate you. So the one problem with MMT, just on the very surface of it, is that there may not be any discipline here. Under QE, there is sort of a semblance of discipline where the Federal Reserve and the U.S. Treasury have to sort of work together. But here, you just have sort of unbridled government spending, and you have the prospect of taxes or less spending to sort of slow things down. Now, if you've been living in the real world for a while, you know that government spending never goes down. Very, very, very rarely, essentially never goes down. And taxes are very, very unpopular, especially in the U.S. And so you have there's a real idea here that MMT will be extremely inflationary. We can talk about that more in another lecture, but I think I should stop it right here. We've gone through the progression from taxing to borrowing from citizens to borrowing from foreigners to the central bank providing all the funding to MMT, where you basically just say, what the heck, let's just print some money and spend it. Hope you guys found this helpful. If you did, be sure to hit that subscribe and like button. Let me know your questions and comments in the comment section below. And as I said, I hope to make a follow-up video to this if you guys are interested. So if you're interested, if you found this not too esoteric but useful, let me know that as well in the comments. Thanks a lot for listening, and I'll see you in the next video.